Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for February 8th, 2021. Please see our disclaimer for important information. In our commentary this week, we have a lot of cross currents to discuss. We've got strength in the equity market. We've got stimulus bills being negotiated. We've got whiffs of inflation lurking about our market, which are beginning to influence certain parts of the investment market. Then we have expectations. We have earnings out, so kind of a lot to talk about. So let's just kind of, just highlight what happened in the last week, which is actually a very good week from the equity market standpoint. The Dow Jones was up about 4% for the week. The S&P 500 was up 4.6%. NASDAQ was up 6%, and the Russell 2000 was up 7.7% for the week alone. Now, of course, year to date, we're talking about January plus a few days in February. But, if you look at year to date, the S&P 500 is up about 3.5%. The Dow Jones is up about 1.8%. And the NASDAQ is up about 7.5%. So, January was a little bit lackluster from a investment return standpoint, but February here, month to date, has been relatively strong because the S&P just in the month of February here is up about 4.7. NASDAQ is up 6%, and Dow Jones is up about a little less than 4%. Now, if you go overseas, if you look at the MSCI EFA index, it's up about 1.6%. It's had a really strong February after a weak January. MSCI Europe is up about 0.8%. And emerging markets continue to be real strong. EM is up about 8.1% year to date. And I really do think that there's going to be a strong case to be made for international stocks. And as we kind of think about this from an allocation standpoint, we're probably going to be focused on some reallocation of some investments into international, on the basis of the theory that we're going to get this synchronized global recovery, although we know, particularly in EM, that the vaccine rollout is probably going to take a little time for some of the third world countries. And so the reaction there may be a little bit subdued, but clearly if you have a weak dollar and you have accommodative monetary and fiscal policy with a lot of spending capacity in the world, that I think you're going to see a reasonable response from international and perhaps in the emerging markets as well, a continuation of that, if you will. Bonds, a little bit different story, but there's a reason why. Barclays aggregate index is down 1.1% for the year, down about 0.4% year to date. A lot of that has to do with interest rates moving a little bit higher. So when you look at the 10-year Treasury, it's now about 1.2%, and it's up about 0.25% just in the year to date. And a lot of that has to do with inflation expectations kind of building into this market. And in particular, when you talk about a $1.9 trillion fiscal stimulus package, and the increasing likelihood that Congress is going to use the budget reconciliation route to get that size package or something very close facsimile approved and put into law, that that in itself amidst the the reasonably good economic backdrop would be in and of itself inflationary. So we'll have to monitor that. The dollar is actually a little stronger year to date after being down about 7% last year. It's up about 1.2% year to date. Gold, as a result of the dollar strengthening somewhat, is now down about 4.5% year to date. And crude prices, which, on the basis of OPEC really coming out and saying that they intend to kind of get rid of the excess inventory that's in the market related to COVID-19, has kind of put a floor underneath crude prices, and it's about 56, almost $57 a barrel last week. Interestingly enough, in some of the commodities, like crude, which was down 21% last year, it's up about 17% this year. And gold, conversely, was up about 24% last year, and now, like I said, it's down about 4.5%. But so we've clearly had some gyrations in the Treasury market related to expectations that are kind of brewing coming out of these fiscal stimulus talks. Some data that we'll kind of get into. There's an employment report we want to talk about. The economy last month only added about 49,000 jobs, and that was less than expected. And the prior month's data was revised down as well. So after kind of stalling out, if you will, after many months of momentum during COVID, we've had a little bit of some fits and starts, in the labor market as of late. Now, initial claims for unemployment insurance fell quite a bit to about 780,000 last week, and that's a positive development. But at the same time, we got a lot of people that are exiting the workforce, and so when you look at the unemployment rate falling to 6.3, it has a lot to do with the fact that people are leaving the workforce and for various reasons being discouraged or lack of available jobs and things like that. So there, for every kind of put, there's a take in the labor market right now. So obviously, and there's, as we've been talking about for weeks and weeks and weeks, the kind of the issues incumbent with the small business sector right now. So I mentioned the let's see. So jobless numbers, we talked about that. We talked about let's see, we didn't talk about the Institute for Supply Management. The ISM Manufacturing Index, even though it dipped slightly in the last reading, it's actually up well into growth territory, expansion territory. That's really positive and uplifting. And the ISM Services Index was also well into expansionary territory. So that's very good. And the expectations are that the stimulus package will certainly continue to help that along. So then if we talk about earnings, so earnings for the S&P 500 have been exceptionally strong. We've got about 60% of the companies that have reported their results, and the growth now is looking like it's going to be positive year over year for the fourth quarter. And that's astounding considering where we thought things were going to wind up just 6 months ago. So the notion in a pandemic of having positive year-over-year earnings is actually pretty stout. And so we've got 81% of the companies that have reported have noted earnings surprises, and the average surprise has been more than 15%, and that's well above the historical average. Financial services firms have really outperformed. So, really positive news coming out of earnings thus far. And so it kind of gives you some feeling that we're going to have some fairly strong momentum, perhaps later on this year. The other thing too, which you can get some more visual feedback on from our charts of the week, is the 7-day moving average of new COVID-19 cases has fallen by 50% since January 12th, and then hospitalizations are below 90,000 for the first time since November. And then, that coupled with the fact that we're getting more vaccines out, I think we're close to 33 to 34 million doses as of last week being delivered, and that's ramping up, and the fact that Johnson & Johnson is on the eve of submitting its application for an EUA to be able to administer their single dose version, I think should give us a lot of comfort in how the data is going to track. And clearly the market is in a kind of a state of euphoria with expectations on vaccine front as well as a stimulus front. And it seems to kind of shrug off this kind of mixed data from the labor market. So again, the market, and we'll talk about kind of what's going on in the market here in a second, but I just wanted to share these kind of high points with you. And we'll also talk about inflation here in a little bit. Payrolls number, let's talk about that a little bit. I said the non-farm payrolls were up about 49,000. The December revision went from like 227,000 down to 140. It was a huge revision. And just kind of keeping in mind that we lost about 9 to 9.5 million jobs in 2020, and it'll take us some time to get those back. And the jobless rate, this would be the unemployment rate, as I mentioned, dropped. It was a fairly strong drop, 6.7 to 6.3. But again, we had a lot of people that were leaving the workforce, and that's not necessarily a good sign. Usually when times are getting good, you tend to see those people coming back in, but the job openings just aren't there yet for them. The underemployment rate, or what they call the U6 rate, continues to fall. That's down below 12%. That's good. But I guess there are some puts and takes to all of this, but private payrolls didn't increase by very much. And 40% of the unemployed have been out of work for 27 weeks or more. And that's the highest percentage that we've seen in almost 8 years. So the household survey was reasonable. I think, again, there are puts and takes in the labor market, but, I think on balance, they are trending in the right way. The data has just clearly become a lot more noisy. And the interesting thing I saw in Barron's was that the average work week was up. It's the highest that it's been in 14 years, and the average weekly hours was the highest it's been since 2000. And we had a really huge spike in temporary services employment. So clearly we've got some unemployed people, we got people working longer hours, et cetera, et cetera. Let's see, more data. Let's see. Maybe things that are influencing the market. So I talked about the ISM, the Institute for Supply Management surveys. They were positive. Stimulus is evidently, very, very influential. Talked about the COVID news, and then we've had really strong response out of some of these areas that were clearly weak last year, like energy, financials, but and there's, I won't say that complacency has set in as much as I will say that exuberance has set in, and that's driven volatility down pretty low. And this thought of inflation, which we'll talk about in a second, has driven yields higher. We just mentioned the 10 years up. I think it peaked at like 1.2%, and the 30 years up just below 2% now. And so since August, the 10-year Treasury note is up about 0.6%, and 30 years up about 0.7. But if we get a continuous rise in the slope of the yield curve, I could see there being some impetus for the Fed to maybe think about raising rates. Clearly, if they see a strong whiff of inflation that begins to materialize as a result of the stimulus package, I definitely think that they'd be willing to step in sooner than they otherwise would. Currently, the expectation is that we're not going to have a rate increase until 2023, but as we know, inflation expectations can change rapidly, and with that, I think that could certainly influence the Federal Reserve and the timing of when they want to get back to a tightening mode. But if we want to talk about where the market is, and I still think that we're just ripe for some volatility here, even though VIX has dropped. But we've got options activity. We've shown charts in our charts of the week about this. Options activity is going through the roof, and there's huge bets being made on the market continuing to go up. And Bitcoin prices are in astronomical levels. And notwithstanding the fact that Tesla bought a bunch of Bitcoin early this week. And then we've got the IPO market for public offerings has really gone nuts lately. I mean, we've got from Wall Street Journal, actually Sandy Leeds reports this in his weekly comments, but companies have raised $13.4 billion through 24 IPOs this year, initial public offerings. That's a 300% increase year over year. And the special purpose acquisition companies, 91 of them have raised $25 billion. And that is basically a third of the total that was raised in last year altogether. And then other signs of a bubble, clearly, 22 times next year's earnings, a price to earnings multiple. Rates are low, but that number is still high. If you got low rates, and we've talked about this, low rates are really mother's milk for equity valuations to increase. And it really, because if you got low rates, there's not as much incentive to go into fixed income. But if you can get that kind of yield or returns in equities, you're going to go there. So I think that's had a lot to do with, the strength in the equity market. The bullishness sentiments amongst money managers is a 3-year high. And according to Sandy, a Deutsche Bank survey said that nearly 90% of 627 market professionals think that some financial markets are in a bubble. So, and if you kind of go on to some of his weekly comments, which I find pretty interesting, the S&P is up 8% since September. The S&P earnings yield, this is earnings divided by price, is at a record low of 3.2%. Think about that. That is earnings over price is at a record low. So that just means that prices have really moved. The S&P dividend yield is 1.5%. And if you look at the 10-year U.S. Treasury, we know that rates have basically doubled from where they were in just the past 10 months. But the 30 years, I mentioned, close to 2%. And the yield on long bonds now exceeds the S&P 500's dividend yield by the most that we've seen since before the crisis. In fact, the Bloomberg Barclays index of AA rated corporate bonds with a fairly long maturity of 13 years yields 1.6%. That is the highest yield that we've seen on AA rated corporate bonds since June, and it's higher than the S&P's dividend yield. And so, it's really rare for equities to yield so much more than treasuries, and so the idea is if rates move higher, continue to move higher, then you could see some of the froth or some of the attractiveness of equities, of equity yields, and such, kind of go away. Because we know equities aren't yielding as much as they were because prices have gone up. And because prices have gone up, dividend yields have gone down. And so as bonds begin to yield more, they become relatively more attractive. And so, we know that stock prices and, price to earnings multiples are definitely affected by interest rates. And that low bond yields typically result in, low earnings yields. We've talked about that. Low yields mean that, longer dated cash flows kind of hold their value. But I think with interest rates potentially moving higher, and we'll talk about inflation in just a second, that could take some of this enthusiasm out of the equity market. So, just want to kind of set that conversation that we want to revisit here in the coming weeks, that, we've had negative real yields. That's like taking the treasury yields and subtracting inflation. And so when you do that, you get a negative real yield right now. And, that has made equities kind of what we call TINA, where there is no alternative. And so, if, those yields on a real basis after inflation were positive, then there'd be less impetus to want to put your money into equities. So, anyway, so that's something that, I think is important to mention here. And, we're basically about a week and a half removed from all of the GameStop melee in the market. And that's just another sign that, the market is at a very enthusiastic point. because you've got a lot of retail investors jumping into platforms. Frankly, a lot of unsophisticated investors that are trying to chase the caboose on the train. And oftentimes those folks get their heads handed to them. But I think there's just some symptoms out there that we are a little bit froth. We have a little bit of froth in the market. But so I'm going to jump in and kind of conclude with this inflation thought. And I thought these thoughts coming out of Brian Westbury at First Trust were pretty interesting. So, he makes the distinction of boosting the monetary base versus boosting the amount of money circulating in the economy. And so, he said basically, during the first period of all of this quantitative easing, after the great global financial crisis, the Federal Reserve bought lots and lots of bonds, trillions. But they also increased a lot of bank regulation and capital requirements. And as a result, what you found is that not as much money made it into the economy. It wound up on excess reserves, being held for banks. And, banks were forced to maintain capital requirements that caused a lot of the money that was injected into the economy to actually not make it into the back pockets of folks. And so as a result, the money supply, grew relatively benign, about 6% on average per year, which is really not dissimilar to the rate of growth of money supply during the 1990s. So we didn't have inflation. But fast forward to 2020, and we've got COVID, and we've got frankly, a lot of Fed asset purchases and a lot of just extreme monetary printing. So all of these different programs and things like that, these loan programs and et cetera, money supply has grown 26% this last year. And that's the fastest growth that we've ever seen in money supply. So, that is the part that Brian's saying, when you have more mobility of money in the market, that's when you have the inflation recipe on the table. So he said in the past 6 months, the consumer price index is up 3.6% at an annual rate. And so you've got money supply, already beginning to impact that. He said the other side of the coin is that in addition to money supply growth, incomes and savings have increased. We've been monitoring that. We know that a lot of people have saved their stimulus payments. Incomes have gone up, but production has not. Even though manufacturing has rebounded, it's still not where it was. And so you've got income that's exceeding production. And so, if you say demand exceeds supply, then that in and of itself is inflationary. So, personal income, wages, salaries, benefits, rents, all of this stuff was up about 6.3% in 2020. And then after-tax income was up 7.2% last year. And that's the largest gain since 2000. And so, you've got all the savings too. So Americans have saved about $2.9 trillion last year alone. And so if you look at like in the third quarter, Brian says the amount Americans held in checking accounts, savings accounts, and time deposits, et cetera, was up 2.8 trillion from the year prior. And if you add this 1.9 trillion in federal government stimulus spending, that is adding a lot of dry powder at a point where production is not yet keeping up. And so what you wind up having is, more money chasing fewer goods, which is the textbook definition of inflation. And so as a result, you've seen the Treasury yield, move higher. And you already have like the 10-year, you've got the inflation protected break-even yields on the Treasury inflation protected notes kind of almost imply a 2.2% increase in inflation over the next 10 years, which would exceed the Fed's level. of tolerance, and the Fed's level of 2% is kind of their threshold above which they are going to want to consider or begin considering raising rates. And so, I think just in the backdrop of what Brian has to say here, more money chasing fewer goods unless production really catches up, and it could, but unless it does, it just provides a lot of upward stimulus for prices in a lot of different areas. And so, as we get into the summer, we want to pay a lot of attention to this. So, inflation is typically not beneficial for the stock market. So as we sit up here now, I think we want to continue to consider downside support mechanisms and things that will mitigate volatility in the equity markets. You can have inflation and growth at the same time. In fact, it happens that way most of the time. You just don't want a lot of unexpected inflation happening or materializing very quickly. And so we'll be watching for that. But I think we're preparing for an environment where we see more inflation. We see perhaps, the Fed maybe wanting to raise rates a little bit sooner. But behind that, we still see global growth, and particularly growth here in the U.S., that is going to still provide earnings growth and more impetus for potentially stocks to move higher. And clearly, if the $1.9 trillion stimulus package gets approved, that will probably put some wind behind the sails of the equity market. But in any case, just some thoughts on inflation to kind of set the conversation for the next several months. We certainly want to monitor that, and you'll be hearing more from me about that in the charts of the week, as we'll be showing you some visual representations of that, as well as these comments here on Market Minutes. So that will do it for this week, and I hope you've enjoyed the program. We would certainly love to hear from you on the comments here today and anything else that you'd like to have discussed during these commentaries. So with the information you see on your screen, feel free to reach out to us. We'd love to hear from you. Have a great week, a safe week, and we'll talk to you again soon.